Monday morning, the banking system hits a new rule. Not a rumor, not a leak, a rule. While most people stared at candles and argued about where price should go, the real move happened in Basel, Switzerland. Basel III endgame requirements are now biting precious metals exposure as desks reopen. Here is what actually happened. For years, banks treated unallocated gold and silver like a shortcut. You could buy metal on a statement without anyone pointing to a specific bar with your name on it. Banks could run huge books of metal promises and fund them cheaply because the old system treated those promises as relatively easy to carry. That era is getting priced. Basel's change does not need a conspiracy. It does not need villains. It just changes the cost of holding certain paper-style metal exposures. And when something becomes expensive inside a bank, it gets shrunk, repriced, or replaced. So the key question is brutal and simple. If the paper version of gold and silver becomes costly to fund, do banks keep printing paper supply the way they used to, or do they pull back and protect their ratios? Now watch this. The rule that matters lives inside the Net Stable Funding Ratio, NSFR. Sounds boring. It is not. NSFR is the fire code for balance sheets. One-line definition. NSFR asks whether a bank is funding an asset with money that can vanish overnight. Why it matters. When funding vanishes, banks panic sell, and panic selling breaks systems. Now apply it here. Unallocated precious metals are not your metal in a box. Unallocated is a claim, a promise, a line item that can turn into a delivery problem if too many people reach for it at once. Regulators hate delivery problems because they become liquidity problems, and liquidity problems become solvency problems. So NSFR punishes unstable structures. It tells banks, if you want to carry paper-style metal exposure, fund it with more stable funding. More stable funding costs more. And when costs rise, behavior changes. Old world. Paper metal could be carried like it was almost risk-free. New world. Paper metal starts acting like a capital-eating liability. I'm John A.G., and on this channel we do not guess. We measure. So we measure incentives. If carrying unallocated exposure is now more expensive, banks will not heroically absorb the cost for the public. They will push the cost into pricing, shrink the exposure, or move clients into structures that look cleaner under regulation. Here's the first uncomfortable question for us. If you hold silver in an unallocated program and the bank decides that program is not worth the compliance headache, do you get a bar or do you get a check? Be honest. This is educational. We manage risk. Now watch this. Banks are not charities. They are machines. They optimize for survival and return. When rules change, machines do not argue. They reconfigure. That is why this can hit the market in weird ways that feel unfair. Not because there is a cartoon villain twirling a mustache, because when a bank needs to improve a ratio, it changes behavior immediately. One change we should expect is a liquidity shift. When market makers are confident, they quote size. They stand in the middle. They take the other side and smooth the tape. When market makers are unsure, they pull orders. Spreads widen. Depth thins. One aggressive buyer moves the screen like a truck hitting a shopping cart. Silver is not a deep market. It is a thin market wearing a loud price feed. So even if the new rule is just plumbing, the symptom we see can be volatility. Whipsaws, sudden gaps, fast reversals, days where the quote looks weak while the physical world refuses to follow. Here is the contradiction that keeps us alert. The rule was designed to reduce systemic risk, but the transition period can create more turbulence because too many desks adjust at the same time. Compliance creates crowding. Crowding creates air pockets. Air pockets create violent moves. If you have ever watched a thin pre-market session, you already know how this movie ends. So we do not worship the candle. We watch the plumbing behind the candle. And we ask the smarter question. If price drops on a screen but premiums stay sticky and delivery times stretch, which market is telling the truth? Here is the second twist. A lot of people hear Basel III and assume it only matters for gold. Because gold is what central banks talk about. Gold is what politicians mention when they want to sound serious. But markets trade on association, not press releases. So even if the rule language focuses on how banks treat gold exposure, silver gets dragged into the same behavior. When banks tighten the paper pipeline, anything that relied on cheap paper supply feels the squeeze. Silver is the smaller room. Gold is the bigger stadium. If the fire marshal raises the rules for tickets, the smaller room chokes first. That is why we keep our eyes on silver. Now watch this. There is a narrative floating around that gold is being treated more like clean collateral under modern rules, closer to cash than to a risky trade. Whether you call it a Tier 1 shift or a collateral upgrade, the practical effect is the same. If a bank can strengthen its balance sheet by holding more hard collateral, it stops seeing metal as just a trading toy. It starts seeing metal as a life jacket. And here's the mind bender. For years, banks made money acting like they could create metal supply with paper. In a tighter rule set, they may end up doing the opposite. They may prefer to reduce paper promises and increase real holdings. When a natural seller becomes a reluctant seller, the floor rises. When a natural seller becomes a buyer, the floor changes permanently. Now picture the collision. Industrial users do not care about ideology. They care about input flow. If silver is needed for electronics, solar, batteries, medical devices, and thousands of smaller applications, factories will buy it no matter what the screen says. Banks, on the other hand, used to treat silver exposure as a balance sheet efficient trading product. If those rules get tighter, the bank stops lending paper supply to keep the price calm. That means the same physical ounces now have to satisfy two hungry groups, industry and finance. And there is not enough slack for both to party at once. This is why you will sometimes see a weird disconnect. Paper price looks soft, but the physical market feels tight. The screen says one thing, the checkout line says another. Here's the thinking test. If silver is down on your phone, but your dealer is quoting higher premiums and longer delivery, which one is reality? The quote or the bar in your hand? Now, do not mistake this for a one-day event. Compliance shifts are processes. Banks adjust in stages. Desks interpret rules. Lawyers write memos. Risk teams change limits. Products get rewritten quietly. But markets are forward-looking. The moment the biggest players believe the future environment is tighter, they start positioning today. That is why we may see bursts of buying that look like out of nowhere. They are not out of nowhere. They are out of compliance. And yes, China has been running more physical-style metal markets for years. When the East leans on physical delivery culture and the West leans on paper, the gap builds up like pressure in a pipe. If the West begins moving even slightly toward the Eastern model, the pipe does not relax. It tightens. The system is admitting a quiet truth. Physical delivery is the final referee. Quick pause, and then we go deeper. I'm John A.G. If you're here, you're not here for hype. You're here because we want the truth behind the tape, and we want it fast. And if you also want silver-related success stories, there's a link in the description to our other channel. Subscribe there too and see how real people use discipline, not luck, to win in this market. Now let's keep moving. The biggest mental trap is thinking that exposure equals ownership. Exposure is a derivative relationship. Ownership is a physical relationship. Basel III pushes institutions to care more about the difference. So here's the mistake most people make. They hold a paper claim, they see a price on a screen, and they assume the claim must behave like a bar. But if rules change, claims can be changed. Bars cannot. This is why we ask the uncomfortable question. If your bank calls your unallocated program metal, but the fine print lets them settle in cash, what do you actually own? Answer that in the comments because the answer determines your risk. Here is the mistake most people make. They think a rule about bank funding only affects banks. But banks are the oxygen tanks for everyone else. When banks tighten, hedge funds tighten. When hedge funds tighten, leverage trades unwind. When leverage trades unwind, markets gap. So one likely ripple is deleveraging in metals derivatives. If it becomes more costly for banks to warehouse large, unallocated metal exposures, they also become less enthused about financing clients who want to pile into similar exposures with borrowed money. That does not mean every fund is forced out. It means the easy, cheap, endless leverage becomes less available. And when easy leverage fades, two things happen. One, short positions become riskier to maintain because the funding and margin dynamics become harsher. Two, liquidity providers quote less size because they do not want to be trapped holding a position that regulators make expensive. This can create a weird environment where price dips sharply on thin liquidity, then rebounds even harder when real demand shows up. So do not fall for the emotional whiplash. Ask the intelligent question. Does a $1 move change the rulebook? No. Does a scary headline change the funding ratio? No. Does a chart pattern override compliance? No. Compliance is a bulldozer. Price action is the dust cloud. Now let's talk macro, because the rulebook does not exist in a vacuum. If banks must hold more stable funding and more capital against certain exposures, they often lend less elsewhere. Credit can tighten. Businesses feel it, consumers feel it, politicians feel it. If growth slows, policymakers usually respond the same way they always do. They talk soft, they stimulate, they try to reflate. That is the recipe for the environment metals love: weak growth, stubborn inflation, and falling trust in paper promises. Fact: tighter banking rules can reduce risk in the long run. Interpretation: the short run can be messy because the system must reprice leverage. Possible risk: if we get a credit slowdown at the same time as sticky inflation, the currency story gets uglier. And here's the part people hate. When hard collateral rises, fiat purchasing power is what adjusts. If gold and silver revalue upward because the system wants cleaner collateral, the unit used to buy them looks weaker. That is arithmetic, not ideology. So we should not be shocked if narratives try to distract you. They will talk about speculation. They will talk about memes. They will talk about anything except the plumbing. But we do not follow rhetoric. We follow incentives. So what do we do with this without turning it into a fantasy? We stop mixing up ownership with exposure. One-line definition. Allocated means specific metal is set aside and identifiable. Why it matters. When stress hits, identifiable metal behaves like property, while claims behave like credit. Apply it here. If banks dislike carrying unallocated programs under NSFR pressure, the first product they redesign is the one that turns you into a creditor. That is the practical risk. And the practical opportunity is simple too. When a market loses cheap synthetic supply, the path to equilibrium is not polite. It is price. Price is the rationing mechanism. If industrial demand keeps grinding and financial plumbing tightens, someone gets priced out. The only question is who. Now here's a question that forces thinking. If a bank is quietly turning down paper exposure because of new funding costs, do you think it tells the public first, or does it fix the book first? Be honest. They fix the book first. So by the time the media discovers the story, the positioning is already done. That is why our edge is attention. We watch spreads. We watch program terms. We watch delivery times. We watch whether dips stop working. Because if dips stop working, it means the seller is exhausted. And if the seller is exhausted, the next move is not a drift. It is a snap. Subscribe now. Short and simple. If you want the next signal when it shows up, you want to be here before the headline catches up. Now, we also have to accept something uncomfortable. Tighter rules can mean tighter credit can mean economic slowdown, and slowdowns can trigger policy responses that push real rates lower. That combination is why precious metals do not need a perfect economy to win. They need uncertainty, leverage stress, and debasement fear. And Basel III adds stress to the leverage layer. So the short term could be messy. We could see sharp down days, we could see sharp up days, we could see fake breaks. But do not let the noise trick you into missing the structure. Structure is changing, and structure changes are what create multi-year moves. Now watch the final pressure point. A rule change like this does not announce itself with fireworks. It announces itself with quiet emails, tighter quotes, smaller size, and sudden cash settlement language that shows up when you least expect it. The first real shock usually comes from the first real stress test. Not the day the rule becomes official, but the day someone tries to pull hard on the system while it is still adjusting. That could look like a dealer refusing to lock price. It could look like a bank closing a metals program. It could look like a spread that stays wide even when the chart calms down. It could look like a delivery window that doubles overnight. And here is the open loop that should keep you alert. If paper supply is being taxed and physical supply is already thin, what happens the first time a big buyer needs size immediately? Do they wait politely for the next dip? Or do they pay up and force the screen to chase the real world? That is why Monday matters. Not because one bell magically changes chemistry, but because it changes incentives. If you want to stay ahead of incentives, subscribe. Short and simple. We move fast here. Now I want your take in the comments. If you had to choose one signal that proves the shift is real, what would you watch first? Bank product changes, lease rates, physical premiums, or delivery times? Because if we are wrong, we will see it there first. But if we are right, the market will not give you a polite warning. It will give you a gap. Promises will get repriced, bars will get hoarded, and the people who waited for mainstream confirmation will discover the worst truth in finance. By the time the story is on the front page, the price already moved. This is where the paper mask slips. Do not blink. The first crack shows up when nobody is looking.